right, welcome to the next Multifamily Investor Nation webinar. This particular webinar is going to be on breaking down real estate syndication structures. And today you can see my whiteboard behind me. We're going to be using that in just a moment to be able to share with you a lot of these different ideas or things around syndication structures. We're going to be, as you can see there on your screen, talking about waterfall hurdles and equity splits and promotes and GP fees and dual equity tiers and all kinds of different fun stuff today during the webinar. I'm going to be going pretty quickly, so thankfully you have the recording so you can actually rewind this if you want or stop it and kind of digest it. But make sure you get out a piece of paper or probably a pad of paper so you can take some good notes as I go throughout these various structures. So make sure you do that. If you want to find out more information about me, you can go to our website here at passiveinvesting.com. I'm one of the managing partners here of a group here called passiveinvesting.com. That's actually the name of the group, passiveinvesting.com. You can find out some more information about our team by clicking on the Meet the Team at the top. You'll see my picture up there as one of the managing partners here, Dan Handford. I actually live here in Columbia, South Carolina with my wife and our 4 children. We have 3 girls and a boy, ages 10, 9, 4, and 3. And so we're definitely got a busy family life as well as the business side. But you can find out more information about me by going to this website here and watching this video with me if you'd like as well. You can also see our current offerings. So right now we have a couple of different offerings available. We have our real estate debt fund, which is basically a hard money fund, loan fund, offers a 6% preferred return with a 90-day liquidity option to be able to get your money out. We also have a self-storage fund. We also acquire self-storage assets. We also have our 2 multifamily assets that are available. One's called Ascend Waterly, which actually closed about 2 weeks ago. We have just a tiny bit left in that asset to be able to fill it up and round it out. And then we have our new asset right now that we're raising funds for, which closes at the end of August, which is going to be Blue Water at Bolton's Landing. So you can go there, click on one of those links and check out the different offerings that we have available for you. And if you're interested in just wanting to join our Passive Investor Club and hear about future offerings that we have available, you can just click on this big blue button on the top right-hand corner that says Join the Passive Investor Club. You can fill out that form, and one of our investor relations team members will reach out to you, discuss your investment goals, and make sure that you're the right fit for our group and vice versa. So with all that said, one last thing I wanted to mention is about the Multifamily Investor Nation Summit that's coming up in January 2022. So we do this twice a year right now, and you can go there, mfinsummit.com, register for that next event coming up in January 2022. It's going to be January 20th. 21st and 22nd. So make sure you go there. It's all online. It's all virtual. All the sessions are recorded, even if you can't attend it live. But you can go there and register for that event and be prepared to be able to be amazed by the amount of content and the amount of education that you will learn from an event like that. So with all that said, let's dive into these real estate syndication structures. So what I'm going to do during this next segment here as we go through this is I'm going to share my whiteboard screen here that you can see behind me. Let me see if I can switch this around just a little bit. Okay, here we go. I'm gonna switch this around just a little bit so you can actually see the actual screen that I'm actually going to be drawing on and sharing on. But I'm going to be standing up and doing this. So because of that, I'm going to turn my video off so that you guys can see what's actually happening on the screen. So I want you to go ahead and raise your hand if you can see this big green circle on the screen here. I just want to make sure everything is working right, make sure the technology is working properly. All right, awesome. Got a lot of you on here. You figured out how to raise your hand. Some of you are still trying to figure out what is he talking about? How can he see me raise my hand, right? Well, on the actual chat box there or attendee list, there's a place for you, or actually on your bar there's a way for you to actually click on raise your hand. So you can raise your hand and interact with me a little bit and tell me that you can actually see the green box or the screen to see the green. Okay, here we go. Now we got a green box on there. So let's do this. I'm going to share with you first a little bit about these syndication structures, right? So we have a couple of things we need to define here, right? We have to figure out what are these waterfalls, and then what's the difference between a waterfall and maybe what's the difference between a waterfall and a hurdle. So you have these things, and then we're going to be talking about these equity splits, right? The equity splits and how those actually occur. And let's see. Of course, we can also talk about what a promote is and what are some equity fees and stuff like that. the actual GP fees. These are fees that are paid to the GP for various things, right? This is how, as an operator, this is how you make money. But it's also important for you, even as a passive investor, to understand these equity structures so you know what you're actually investing in. So the first thing that we're going to do today is we're going to kind of break down really kind of what these waterfalls and hurdles are, and then maybe even come in here and do the equity splits just a little bit. So let's do that first. So the first thing we're going to talk about is the waterfall. So when you think about a waterfall in equity structures, you should really think about a waterfall in general, like, right, literally a waterfall. And I'll give you an example of what I mean. So we're going to start off and just pretend that we have a couple of buckets here, okay? So we have this first bucket that's right here, and then we have another bucket that sits down right here, and then we have another bucket that sits down right here, right? And we could also go down and even further if we wanted to, right? And so what we're going to pretend is normally when you think of water, you think of like a color of blue, right? Because of blue water. And so today, because we're talking about cash, we're going to be using a green color. Okay, so let's use a green color today. And what's going to happen is when you think about a waterfall, obviously you have to be filling it up with something. So we're going to say we have this cash over here, and we're going to be filling up this bucket with cash. And we're going to pretend the cash is our water. So once this water or cash is being poured in here, once it hits the top, guess what happens? It spills over and starts to fill up the next bucket. And then what happens here is this bucket's going to continue to fill up. And once it reaches the top, what's going to happen there? It's going to go down. It's going to fill up the next bucket. And it's going to continue to do that depending on however many buckets you have, or until what? Until the cash or the water runs out. Because now at this point, it might only fill up to there and it never fills up and it never goes anywhere else. Which in the last bucket, that's actually what's supposed to happen is that you're not supposed to have it. It won't actually fill that bucket up because the bucket is an infinite bucket at that point for the last kind of bucket, if you will. But this is how you should think about an actual waterfall itself, right? So let's talk about this just a little bit. Let's bring this kind of more towards the middle here, and let's talk about because really we could answer a lot of the questions that we talked about as far as like what are waterfalls and hurdles and equity splits and stuff like that with this illustration right here. So in order to determine how much you're going to fill up in each bucket, you have to know really kind of what's in each bucket, right? So let's just do this real quick. Let's move this over here just a tad bit, and we're going to go back to our simple buckets here. We're going to put a bucket here. We're going to put a bucket here. And just for funsies, let's put another bucket down here, right? So we have these three buckets that are displayed here. And in these different buckets, there's going to be different hurdles, right? So really the first hurdle that's kind of going to come into play here is going to be this first hurdle here, right? And let's just say this one, just for all intents and purposes, is the preferred return. This is the pref. Let's just call it 7%. That's what's common right now is a 7% preferred return, especially when we're talking about a single tier equity structure, which we will define the differences between a single tier and a dual tier equity structure just here in a little bit. But this is where that first hurdle is going to be. So we're going to call this the first hurdle. This will be the first hurdle in the waterfall. And let's just figure out the next hurdle, right? The hurdles are really where you go from one bucket to the next. So the hurdle is once we hit that hurdle, boom, now it's going to start to fill up another bucket. And so the next bucket is going to be this bucket down here, right? And this hurdle is actually going to be our second hurdle. And this hurdle is going to be what we call, let's just call it an IRR hurdle, okay? So in our group, a lot of times it's 13%. So once we actually hit this 13%, the splits change. Now, when we talk about equity splits, this is actually another piece that we have to talk about is that inside this bucket, all the cash that's coming into this bucket for the preferred return, because 100% of the cash flows goes to the LPs, in this situation. So 100% of the cash flows of the I'll just say the cash flow goes to the LPs, right? To the LPs at this point. So when that cash is coming in, 100% of the cash flow is going to go to the LPs here. Once it actually reaches the top up here, that's when it's going to hit this hurdle, the 7% pref. That's how it hits the pref. 100% of the cash flows goes into that bucket until it reaches that 7% pref. Once it hits the 7% pref, now it's going to start filling up this bucket here. Now, the hurdle on this bucket, the second hurdle, is actually this IRR hurdle here, right? It's a 13% IRR, which what I mean by that is that the next hurdle that's going to happen before there's any type of split is going to be this 13% IRR. So after 100% of the cash flows up here goes to the investors, so the LPs, to hit that 7% pref, what's going to happen next is you're going to have this equity split where the LPs are going to get 30% and the GP is going to get the LPs are going to get 70%, the GPs are going to get 30%. The LP are the limited partners. Those are the passive investors. Those are the people that bring in money to be able to close a deal. The 30% is to the GPs, the general partnership. That's you, right? And so this is going to be that 70-30 split. Now, the cash flows that are coming into this bucket are going to continue to fill up this bucket until it reaches this hurdle right here, which is a 13% IRR, right? Now, once it hits this 13% IRR, then the cash starts to go down into the next bucket. And at this point, the equity would change, like in our deals, it would split 50-50. So now the remaining cash flow goes to 50-50 in this particular situation, okay? And so at this point, there is no third hurdle here. This is really what is called a dual hurdle equity structure, where you have three different buckets with two different hurdles. Now you might think, well, what about this one? Is this another hurdle here? No, it's not in this situation. You could, right? Then you would have to put another bucket down here, right? Because you would have another hurdle here. Let's just say you did like an outperformance hurdle, like a 20% IRR, to where it goes 50-50 until it hits that 20% IRR. Then it starts to fall down here, and then maybe it flops around. Now it's like 30-70, 30% going to the LPs, and then the GP is getting 70%. So you're going to outperform by getting over 20%. Then of course, you can do another split there. Now this would actually be the third hurdle in the actual waterfall, and you got 4 buckets. Does that all make sense? Hopefully that makes sense to everybody. Raise your hand if you're tracking with me and you follow along with what we're talking about here, because I know a lot of this stuff in the very beginning can be a little bit more complicated, a little more complex, a little bit harder to understand, but this is definitely going to be something important that you want to understand. Now, I know there's a couple of you asking questions about how are these numbers calculated, and we'll go through that here real quick as well. So let's just go ahead and do that too. So let me change the color here. Let's actually go through and use green again, because I like to look at green because it reminds me of cash, right? So we talked earlier about that. Cash, it goes into the bucket, fills it up. It's going to go into the next bucket. It's going to go to the next bucket. And of course, if you have another hurdle, it's going to go into the next bucket there as well. But the question is that everybody's asking is this 7%, what is this 7% based off of? So this is the preferred return. Well, the preferred return is always based on one thing. It's unreturned capital contributions. Okay, it's this unreturned capital contribution that 7% is calculated off of. So let's just do a little bit of quick math here on this unreturned capital contribution here. If you put in $100,000 into a deal at a 7% pref, that's going to give you, let's just multiply that. That's going to give you $7,000 every single year. It's going to give you that $7,000 every single year. And let me see here, my trusty brain is not working here. So if we do $7,000 a year, right, and you divide that by, say, 12, what's that going to be? So divided by 12, that's going to be roughly $583 and some change, right? Roughly $583 and some change for that 12-month period of time, right? And so 7% preferred return. Now let's say that we had some form of capital event and you received back 25,000 of your 100,000, right? So now this unreturned capital contribution over here is also sometimes called the UCC, right? Unreturned capital contribution. It can also be considered the unreturned invested capital or something like that, but unreturned capital contribution is very easy to understand if you understand what those words are. So let's say you received already $25,000 back. Now your unreturned, your UCC, right? Your UCC is now going to be 75,000, right? Does that make sense to everybody? Raise your hand if you're following that, right? So you started with 100,000 and you received $25,000 back because of some sort of like, refinance or supplemental loan or something like that. Great. Glad you guys are following along. All right. So now we have this $75,000 and the $75,000 at 7%, right? Because we have this 7% preferred return that we're spinning off of. This is now going to be 5,250, right? So you take that 5,250, you divide it by 12. This is going to end up being $437.50, somewhere around in there, right? So we have this now. Because you received this capital back, you had a capital event. Now instead of receiving 583 every month or however you're receiving it, it's going to be down to 437.50 every single month. That's the unreturned capital contribution, and that's how these are actually calculated. Now, one important thing to understand, especially as a passive investor, is going to be what is called return of capital. This is just an extra golden nugget because it wasn't part of this webinar, but return of capital versus return on capital. Now, you might think, first off, let me ask you this. What's the major difference between these two right here? What's the major difference between these two? Okay. The major difference is one letter. There's one letter that's different. It's this letter right here, the F and the O. Those are very, very important letters here that you have to make sure that you look for, because there's tax consequences here as well. There's also return consequences for you as an investor at the same time. What you always want to make sure that you're doing, especially as a passive investor, and this is important for passive investors to understand, but it's also important for active operators to understand how this works, so you can make sure that you take care of your investors, right? Because if you take care of your investors, they will want to invest with you for life. There's a reason why our group has a 62 to 63% repeat investor rate. It's not because we just try to take care of ourselves. It's because we really try to look out for our investors and make sure that they can maximize the return that they can get on the assets that we put together. We are investors as well, and so we take care of ourselves with the investors, but also we want to make sure that we're taking care of our investors, because we can't close the deal, the size of the deals that we're doing right now, if we're not taking care of our investors. When we close our Blue Water deal that we have under contract right now out of Charleston, South Carolina, we'll have raised this year just over $80 million from our investors, which is pretty powerful, right? It's very powerful to see that that's the amount of capital that somebody can actually raise. And actually, just before this, I was on a phone call with an institutional group that wants to place institutional money with us. And he said, we got $100 million to place that we want to be able to put out there. And I'm like, yeah, but I don't need institutional capital. We want to make sure we're taking care of our retail investors, our high net worth accredited investors that don't normally get to invest in these types of assets, instead of allowing it to be offered to institutional groups. But you want to make sure that you're always looking at distributions. Should be, this is the distinction here, the distributions should always be return on your capital. You want your distributions to be return on capital. And the reason why this is important is because hold on just a second here. The reason why this is important is because if you remember back over here, we talked about this unreturned capital contribution, right? We talked about these unreturned capital contributions, and that's what your preferred return is based off of. And if you're getting return on your distributions, if your return on your distributions is calculated as return of capital, that means that this UCC is going down every single month that you receive, or every single quarter that you receive a distribution, which means your return is going down. And technically, because it's return of your capital, you're not actually making a return at all. You're just getting your money back that you put in, right? And so the only person that benefits is the operator, because they're going to be able to hit their equity hurdles faster that we talked about earlier. They're going to be able to hit these hurdles a lot faster if they can reduce this. If they can reduce that preferred return amount, then they get to hit those secondary and tertiary hurdles a whole lot sooner. And so the only reason why you would have that done is for the operator. So as a passive investor, you always want to make sure that you are looking for distributions as return on your capital for your distributions. Now, you're going to always have capital events, or of course, when you sell, now you're going to want that return on capital, or return of your capital, right? And hopefully return on your capital on top of it. But we're talking about distributions. These cash flow distributions during the hold period should be calculated as return on your capital, not return of your capital. This up here is a big no-no. All right, so we talked about that a little bit. Let me see if I got some questions in here. Give examples of some hurdles. We talked about some of those a little bit here. If you have some further questions about that, let me know. I think we already touched on that. Let's see, can we use real numbers to illustrate the flow? It's kind of hard to do that because you have to go through an actual deal itself in order to do that. So it was a little bit harder to do that. Can you touch on preferred equity versus common equity? So yes, let's talk about that just a little bit too. So we're going to scroll this over here just a little bit, and we're going to talk about the capital stacks. This is important to understand too. So when you think of a capital stack, I know some people are kind of crazy, at least I call them crazy. You can call them whatever you want. I call them crazy because they think that stacks are built from the top down or from the left to the right. But whenever I was a kid and I was building Legos, I always built them from the bottom up. I never started at the top and then built it. I didn't build everything from the top down. So whenever you think about a capital stack structure, when it comes to equity structures, you always build a capital stack from the bottom up, right? So let's first put the bottom box down here. And this is going to be our capital stack, right? So and typically at the bottom of the capital stack, which is typically the largest portion of the stack, is going to be your debt. This is going to be where you're going to get your loan. The lender is always the largest investor in most of your properties. And then let's do the capital stack, which will be a single tier hurdle, and then we'll do a dual tier hurdle. So I'm going to do a generic one here. This is going to be another portion of the capital stack here. This is going to be your common equity. Let's just call this common equity class A. And then you're going to have your GP slice up here. Usually this is going to be considered common equity as well, but it's going to be in a different class, which is going to be, on this one, we'll just say class B, right? So this is a very simple, a very basic capital stack structure. You have your debt at the bottom. You have your class A, which is, this is going to be your LPs, and then you're going to have your GP right here. Okay, this is a very simple, very basic version of a capital stack. Okay, this is actually a very common one we used to see many years ago, and now we actually have changed quite a bit, where we actually have a dual tier structure, maybe even a piece for some preferred equity. And so what you'll see when I talk about preferred equity slices, what you'll actually see sometimes is, let's just make a large stack here and we'll split it up. You'll see the debt down here, just like normal, okay? And then here, you'll actually see a pref equity slice. And this can either be with your LPs or an outside group. And then you'll see your common equity. This will actually be a common equity A. And then you can see this common equity B, right? Now, a lot of times these are split up in a couple of different ways. So let's do a little bit of a different one. This one's more of a complex equity structure. So again, as usual, you're going to have your debt at the bottom down here. And then you might actually have a class A This is going to be your pref equity piece. And then you might actually have, let me erase that real quick. I'm going to put this back here. And then we're going to come up here, and then we're going to have usually there's a larger stack here for the Class B. This is going to be your Class B, and this is going to be more of your like common equity style, right? This is going to be your common equity. And then of course you're going to have your GP shares up here, which is going to be, we'll just call this Class C. So you have your Class A, your Class B, and your Class C shares. Now, one of the other things that you have to understand when we're talking about these equity structures is you have to understand the risk profiles here, right? So the lowest risk in this is down here. This is the lowest risk, right? Low risk. And then as you go up, you actually get higher and higher risk, right? So the closer you are to the debt, the lower the risk you have, which is why when you see a dual tiered structure, this Class A investor is a lower risk investment because it's very close to the debt and also gets preferential treatment in distributions, but also in return of capital. And so that's why it's in that lower risk position. Then of course, then you have your Class B, and of course the highest risk is always going to be your GP shares because you have to be able to pay back your debt and you have to be able to pay back your Class A and then of course your Class B before you can actually start getting any type of return from the Class B side of things. So risk profile is there. And then you also have, let's see, return. So your return is also going to be, this is going to be a high return. And then this is going to be a low return. And that's all commensurate. If you look over across, it's very similar to what we always talk about, right? A low risk investment is going to provide a lower return, and a higher risk and higher risk up here is going to provide a higher return, right? So same thing, high risk, high return, low risk, low return, which is why the debt is usually, you know, right now you can get it for what, 2.5 to 3.5%. It's because that debt is very, very cheap. And it's the lowest risk investment you can have inside of these assets. And then of course you have your other returns that would be commensurate with the risks as well that are inside of this capital stack structure. So, all right, so we went over quite a bit today, more than I actually thought I was going to go over today, went through quite a bit. Let's talk first about the promote. I know some of you, I know there's a couple other questions in here that I'll try to get to, but the promote itself is basically when you're going to be able to, I'll bring it over here so you can actually see this right here. The promote is basically going to be this right inside here. Let's see, you get this, see if you can get this. This 70-30 split is going to be your promote. So you're going to get after this first hurdle of this 7%, you're going to get the GP is going to get a 30% promote. This is a 70-30% split. And then after that second hurdle at the 13% IRR, then you're going to get a 50-50, you're going to get a 50% promote, 50% promote on the GP side. That's what the promote is. It's basically saying how much are you going to get for your sweat equity, if you will, for putting the deal together itself. Okay. So preferred equity is there's one of the questions that Curtis has in here is about preferred equity, and the preferred equity versus the common equity A and B. So if we go back over here to our illustration, so if I can find it here, here we go. It depends on how you do it. So for example, this preferred equity slice could be classified as just preferred equity, and it could be either, actually it could be it could be actually debt or equity. It could be preferred debt or preferred equity. Most of the time when you see this, you'll probably see it more as the preferred equity slice, and they could have their own class of shares, but really the class of shares is really based on how you want to label it. This could be class, you know, element OP for anybody else cares, as long as there's a different labeling for that particular class. But the preferred equity is basically just saying you're putting money in and you're going to get preferential treatment on cash flows, distributions, and then also with the actual return of capital at the end when you go to sell the property. And then of course your common equity is basically just going to be your typical splits where there's still might be a pref, and instead of it being like a higher 9 or 10% pref, you're going to get like a 6, 7, or 8% pref, but then you might also have lower cash flows, and then you also don't have the ability, you don't have any, you'll get the, you as a common equity investor, you get the ability to participate with a lot of the upside potential. So even though you might only have a 7% pref here, you might have a potential to get, 16 to 20% plus return on the back end. And that's really where the biggest difference is, because usually the Class A preference is going to be a maximum return. So like in ours, we give a 9% preferred return that's paid out monthly. They get the first cash flows before Class B, but they don't, because they get this preferential treatment here at 9% and they get paid out first, then they get no participation in the upside. The maximum return that they will ever get is 9%. But for somebody who wants cash flows, that's a great investment for them, because it's about as close to a guarantee that we can give somebody, that we can give them 9% on their cash, and then when we're done, we'll give them their cash back. Because that's usually only about 20 to 30% of the capital stack, it's a really low risk investment for those people who really want to have cash flows during the hold period. All right, let's see, GP fees. Let's talk about GP fees real quick, and then I'll go over to answer some of these questions for everyone. Let's go over these GP fees. Typically, what you're going to have on the GP fees is you're going to have a couple of common fees. Obviously, when you close the deal, you're going to have what is called an acquisition fee. And instead of writing the word fee out every time, I'm just going to write out the words because I think you guys understand that I'm talking about fees. All right, so we have acquisition fee. You can have a what's called a guarantor fee for someone to sign on the loan. You can have disposition fees. And then you can also have asset management fees. These are the common ones that we use with our group. The acquisition fee is these right here. These two are paid at closing. Okay. Typically, the acquisition fee is going to be 1 to 4%, depending on the size of the asset. The guarantor fee might be 0.5 to 3%, again, depending on the size of the asset. The disposition fee is going to be usually 1 to 3%. And the asset management fee is same thing, kind of probably 1 to 4%, somewhere around in there. And the asset management fee is usually paid out monthly, and it can either be paid out based off of the monthly income off the asset, or the equity into the deal. So it's like an equity under management type deal. That's how it can be calculated off of. The acquisition fee is usually, both of these are typically usually paid out of what it might be like the purchase price, if you will, those total transaction costs initially. And then of course your disposition fee is going to be based off of the sale price, right? The sale price itself. And so that's kind of those are the main GP fees that you would normally see. There are some other fees that you could charge. You could actually charge if you're doing the property management, you could charge a property management fee. I just abbreviated management. You might not like the way I abbreviated, but that says management to me, property management. And then you could also charge construction fees if you're managing the construction. Yeah, that might be better for management. Construction management fee. I've also seen broker fees. Usually, when you start to see additional fees, you can also real estate commission fees. I mean, there's a lot of other fees that you could charge, but the most common ones that we see and the ones that we do are going to be these first 4 right up in here. Okay, those would be the first 4 fees. Now, one of the things that we do different with ours is 2 of them are what we would call performance-based. So these 2 fees right in here are actually performance-based. So the disposition fee we only take if we hit a 13% IRR. So if we hit a 13% IRR for our investors, then we take a disposition fee. And then on the asset management, if for some reason we have to stop distributions to investors, then we stop taking the asset management fee as well, because we don't feel like it's best for us to continue to take the asset management fee if our investors are not getting the money that they are projected to get from their return. So those two are what we call performance-based fees. Obviously, the acquisition fee is pretty straightforward. It's for putting the deal together and also losing a bunch of other deals that you didn't get and paying for that, putting the deal together, structuring it, getting all the investors together and closing the deal. And of course, the guarantor fee is paid out to the loan guarantors on the deal for their efforts and maintaining net worth and liquidity during the actual hold period itself. All right, so let me go through some of these questions and see what happens here. There's quite a few questions in here. Let's see. All right, what is the 7% calculated on? We already answered that question. What is the time frame for these? The time frame is dependent upon the deal itself. So it could be, a year and a half, 2 years in. Could be when you sell. It just really depends on the deal itself. Maybe share an example with specific past investments. So Guillermo, I would do that, but it takes a little bit of time to actually come up with the numbers and put them through the whole waterfall. It takes a little bit of time to do that. But maybe we'll do it on one of our future webinars, because it does take a little bit of time of preparation ahead of time. And I did not prepare that well for this particular webinar to be able to give those specific examples. So let's see. Do you deal with accredited investors only? Do you know how to locate GPs that are looking for sophisticated investors? I don't really necessarily know how to look for them, other than the fact that you just need to get out there and start interviewing a bunch of people and understanding and interviewing them to see who is out there, and networking and asking other people for it as well. The percentage return is annual. Yes, that is correct, Jessica. There's an annual return that we're referring there to as far as the preferred returns or the IRRs. Let's see. I'll skip this question. And can you talk to what a passive investor can expect to see during tax season? For example, what a K1 will consist of, how depreciation is passed along, etc. I won't go into a lot of detail here, AJ, but typically what you might see is on a K1, so let's say you invested $100,000 into an asset, right? Let's say you invested $100,000 into a deal. And at the end of the year or throughout the hold period, you received some cash flow. Let's just say you received $5,000. Just making some numbers up here. But let's say you received $5,000 in cash flow, and this particular asset gave you a 50% depreciation benefit, right? Depreciation benefit you will receive. So that means at the end of the year, you're going to get a $50,000 loss due to depreciation, the depreciation benefit. And so if we're gonna add in the cash flows, because you actually made those cash flows. So we're gonna take this $5,000 that you made, we're gonna take it out of this $50,000, and now you have a $45,000 loss. This is what is called a paper loss. And so at the end of the year, you'll get a schedule K1. This will be that K1. You'll get a K1 that shows that you lost $45,000. That $45,000 can be used to offset any other passive income. If you're a passive investor, if you're an active real estate investor, then you can offset more than that. You can offset even some of your ordinary income and other gains that you might actually have, which is very important when it comes to the real estate professional status. So hopefully that helps you there, AJ. How much are PM fees, the construction management fees? The PM fees are usually going to be anywhere between about 2.5% on the low end, upwards to 10%, just because it depends on the size of the asset, whether there's on-site management, various things like that. Some of your higher quality assets, like we're buying right now, we get 2.5%, 3.5%, somewhere around in there. Construction management fees I've seen as low as 5% and even as high as 20%. I would say the most common is between 7 to 10% when it comes to the construction management fee. Are those GP fees based on our capital or on the purchase price or the raise? What is it based on? So when it comes to the fees themselves, so I talked about this a little bit about the asset management fee is based off of the income or the equity under management. The disposition is based off of the sales price, and the guarantor and the acquisition fee based off of the purchase price or the total transaction cost, if you want to include closing costs in there as well, and also the CapEx. The property management fee is based off of the gross income off the asset. Construction management fee is based off of the CapEx that is spent. the CapEx spent. And then, of course, these two would be off of the actual purchase price of the asset as well. So hopefully that was helpful for you. That was kind of shrunk down just a little bit. That's why I like this whiteboard, because I get to move around a little bit and can bring up some of the prior examples from before. All right. The disposition fee is paid at the end, so it would not be paid monthly, but the asset management fee would be paid monthly. Can the syndicator charge an acquisition fee without having money on the deal? Yes, you can. It is possible to do that. I see that happen all the time, but I personally recommend investors not to invest with a syndicator unless they actually put money into the deal. I want to make sure that there's some skin in the game for the actual syndicator themselves. So could you do it? Yes, and it does happen, but I personally will not invest with it if you're not actually invested into the deal itself. As to that return of capital versus return on capital, even if it helps the operator reach the hurdles, doesn't it benefit LP investors as well as to the deferred tax impact of early years distributions that are dispersed as return of capital, meaning as a passive investor, you won't have tax impact until year maybe 4 or 5 toward exit. I'd like to understand this better. That still makes no sense, Kiki. Now, you might think about it in the beginning that it makes actually a lot of sense, but it actually doesn't, because if you think about it, from a tax perspective, if I do return of your capital with distributions, and you're thinking, well, if I do it as return of capital, they don't have any returns, so they're not paying taxes on that. Well, I'm not paying taxes on it anyway because I have depreciation. Remember this example over here? Why would I care if I'm being taxed on this? Because I'm not. This depreciation benefit is going to offset any cash flows I get during the hold period. So it does not benefit the investor at all. The only person that it benefits to do return of capital versus return on capital is the actual operator themselves. But this depreciation benefit here offsets my cash flow, so I don't care. I mean the way I care, meaning that I want it to be return on my capital so that my return doesn't go down over time, which also allows the operator to hit their hurdles first. So again, my overall return is going to go down if I do that. So my preference is always to be able to get the cash flow, offset it with depreciation, because this is going to be able to allow me to offset that cash flow for the rest of it. Because if I don't use this full $50,000 the first year, even if I didn't get any depreciation years 2, 3, 4, and 5, I got $45,000 worth of depreciation that I can now carry over to years 2, 3. This is supposed to be a Y. Use 3, 4, or 5. Okay. Hopefully that makes sense. All right. Cool. Good. All right, thank you, Kiki. What factors do you take into consideration when structuring the deal, and at what point you structure the deal? Well, I would say that our structure with our deals is actually fairly similar on most of the deals that we actually do. So it's going to be a very simple structure. We typically do this structure right here. However, we do not do, let's just come down here. We do not do this one down here. I'm just going to take that one out of here. We don't have this third IRR hurdle or anything like that. We just basically have these 3 buckets and 2 hurdles. 100% of the cash flows goes to Class B, 7% preferred return. That's the first hurdle. Then it goes to a 70-30 split. Oops, I'm erasing it now. Goes down to this 70-30 split, and then comes down to a 50-50 hurdle. So if we can't find deals that allow us to do this hurdle, then we don't do it. Right? So we're actually looking for deals that will actually allow us to use this hurdle, where we know we can still get great cash flows for us as the GP, but also great returns for our investors at the same time. All right, let me see if I missed any of these questions. I did all the ones in the Q&A box. Let me see if there's any of them that I missed in here inside of the chat box. How does the IRS handle return of versus return on? We kind of already handled that as well with Kiki's question. Let's see, disposition and ask for paid monthly. I've seen a few deals. If it's paid out over several years, there's more protection for the LP. So Lee, if an acquisition fee is paid out over several years, it usually means that there's not enough money up front to be able to pay the acquisition fee, or it's possible that they just were not able to, or they didn't want to raise that extra money up front as well. So acquisition fees are rarely paid out over several years. They are typically paid out in the beginning when you close the deal itself. Lots of terms and initials not explained. I tried to explain as much as I could while I'm going through it, but if you have any questions about any of this stuff, let me know. I know some of this is a little bit complex, but as I was saying an initial or abbreviation, I was talking about it. So for example, you see this right here says CF. That actually stands for cash flow. So if you go and watch through the recording again, you'll see that I actually said cash flow as I said that. LPs, of course, GPs, limited partners, general partners, IRR, internal rate of return. There's a lot of other videos, educational stuff that we do every single week that goes through and explains a lot of these terms that maybe we didn't actually cover for you today. So Santa said, you know, if you said you won't invest on a deal if the syndicator doesn't have money to invest on the deal, but what about if the syndicator has a good track record? Well, if they have a good track record, they should have enough cash flow and be very well capitalized that they would want to invest in their own deal. That's my point is, yes, they might have a good track record, but why would they not invest in their own deal? To me, it makes no sense because they're going to get paid really well on the deal. So invest in the deal. Show your investors that you actually like the deal so much that you want to invest in it as well. Okay. Let's see. If the property is sold at, say, 5 years, will any of the depreciation have to be offset by capital gains? You will have depreciation recapture when you sell, and then you'll also have a capital gains as well. So it doesn't necessarily offset any of it. It actually gets added on. So you actually have depreciation recapture and capital gains, which actually would be something that you'd have to pay for whenever you sell the asset, which is why at the end you should hopefully do a 1031 exchange and move it into the next asset. If I participate through a Roth IRA, or excuse me, through a self-directed IRA, Roth or traditional, how does the K1 work? Can it offset any income? No, not really, because it's going just, you already are getting the tax benefits through the IRA itself. So the K1 really doesn't help you that much at all, except for maybe to offset some UBIT tax or, you know, something like that, but it doesn't really benefit you too much. When will this be available for a replay? So usually Melissa gets these things out pretty quickly. So I would say maybe sometime this afternoon, it'll be sent out to everyone so you have a copy of the replay to be able to go through it again. Is there a tax consequence to the GP? Yes, there is. So you do have to pay taxes on the gain that you actually receive when you actually sell the asset or on the others as well. All right, if you have an acquisition fee of $1 million, might make sense to have it spread over 3 to 5 years. Well, I mean, it depends on the deal itself, right? If the deal is so tight that it doesn't make sense to pay you $1 million and it has to be done over 3 to 5 years, then sure, you can do that. But if you already have the $1 million sitting there, then why not just go ahead and pay you the acquisition fee if it's already there ready for you to get? So to me, Lee, it is possible to do that, but it's only, to me, it only makes sense to do that if your returns are just so tight that it only makes sense to do that. Okay. What are your thoughts or feelings about syndicators who invest their acquisition fee in the deal instead of investing new cash? I'm fine with that. I have no problem with that. The problem that I see is that people who make the acquisition fees, but they don't invest in it at all, whether they don't roll any of the acquisition fee in or they don't invest new cash at all or nothing, right? That's where it doesn't make sense, because right, whether they invest part of their acquisition fee or they're investing new cash, guess what? It's still their cash, because at the end of the deal, they're going to get that money out anyway. So for me, I don't have a problem with that. I think it's fine. At a minimum, though, I do want to see at least $100,000 invested in each deal that I personally will invest in as well. All right, I got 2 minutes left. I'm not going to be able to answer all of these questions that have come in here towards the end there. But I want to thank every one of you for being in here. Hopefully this was valuable to you. Hopefully you found some benefit in actually seeing this and actually being able to understand this a little bit better. I know with my whiteboard illustrations, hopefully it makes it a little bit more palatable for you to be able to understand it. And I'm glad to be able to kind of help walk you through a little bit and get you to the point where you can actually understand it, right? I want you to understand these as much as we can, which is why I spend the time that I do to go through each one of these examples to be able to show it to you. So hopefully if you have some questions, obviously there's a lot, go watch this video again, but if you have some questions, let us know. We'll try to answer as many of those questions as we can, but thank each one of you for being here. Thank you for participating, and thank you for answering lots of the questions that have come in. There's definitely been a lot of questions come in, And I always would prefer to have more questions than not enough questions, because it makes the time go a lot faster. It also makes for a more valuable session for other people. So thank you so much for being here. Look forward to seeing you here next week. Next week, we have another webinar. It's going to be on finding partners or investors for apartment syndication. Brandon Abbott is going to be on there talking about that. So make sure you go to the webinar registration page and register for this next one. So thank you so much, and we'll talk to you later.